Thank you, everyone. Good afternoon. Welcome back from lunch. I'm very excited to be here with you to talk about developments in the economy that we've experienced over the last year, some of the developments that we've experienced so far this year, some developments that happened just last week, and some other developments that happened this morning. I know everyone was really excited for the inflation report that came out today, and so I'm going to tell you everything about that and what it means. So today's presentation is going to be similar to the ones in the past. We're going to go through four segments of the economy: growth, employment, inflation. However, we have a new fourth section that we're going to talk about today. Now, this does not mean that interest rates and the Fed are not important anymore. If anybody wants to talk about the 10-year Treasury rate, be happy to talk your ear off about it later. But we've heard feedback from our stakeholders that we want to be looking towards the future. And specifically in that last section, the future, we're going to look at the future of work and how that is evolving with technology and all of the things that are going on. Now, this year's presentation, also a little bit different in past years, could be called the state of the labor market instead of the state of the economy, because the labor market has really been the key area of development to watch, not just for the overall outlook, but for workers' compensation as well. And so with that, instead of starting in growth today, we're going to start with employment. And I'm going to start with a fact instead of a question. I know you guys probably are sick of my questions now. The slowest year of job growth in more than 2 decades outside of a recession. In 2025, we experienced job growth. You have to go all the way back to 2003 for the last time the economy added so few jobs outside of a recession. Now, it didn't last very long because now I do have a question for you. Are things shaping up better in 2026? Everyone knows, right? Because you've been following our labor market insights reports, I'm sure. But we'll dive into that. And then lastly, more of a philosophical question for the audience. Can the labor market be simultaneously strong and weak? Who thinks yes? Raise of hands. Who thinks no? Who thinks, why is this guy asking us questions? He just said he wasn't going to. I'm sorry, I'll try to keep them back, but habits die hard. So we're going to start today with what Donna showed you this morning in the state of the line. The labor market encapsulated between employment and wages. And this is because ultimately at the end of the day, the largest impact from the labor market on workers' compensation is on payroll. But there are other indicators that we're going to look through as we go through this presentation that are going to give us more of the backstory of what's going on. But first, just a summary. 2025, again, we saw 0.5% employment growth, the slowest that we've seen outside of a recession since 2003. And if you look down the industries, largely this was a healthcare story, a one industry story. Wage growth on the other side, relatively strong across the board, and was the predominant driver of payroll growth. And so we're going to look at some indicators to assess how sustainable is that trend in wage growth and what it's going to mean for payroll going forward. So today's labor market story is going to start with the demand side of the equation. We're going to start with job openings. Now, there are a couple of things that I want you to look at on this chart. First, notice the trend over time, naturally rising, but we do see job openings soften in periods of economic stress. Recessions is indicated by the gray bars. Also notice that coming out of the pandemic in 2021, we saw a steep rise in the number of job openings. This was the time period that the media dubbed the Great Resignation. We like to call it the Great Reshuffle because we think it's a more apt description of what was happening during that time. But then since in 23, 24, and now into 25 and 6, we've seen job openings soften once again. And we're now back at levels commensurate with what we experienced prior to the pandemic. Now, job openings are an indirect measure of labor demand because they don't necessarily tell you exactly what companies are doing at the end of the day. So let's instead switch to the direct measure of labor demand, and that's actual hiring. So here we have the trend of hiring, and there are a couple of similarities that you'll notice from job openings. We see hiring typically naturally rising over time. We see it decline in periods of economic stress, recessions. Coming out of the pandemic, we saw it rise during that Great Reshuffle period, and lately in the last couple of years, we've seen it soften again. But there's one key difference to point out, and that is the dotted line. Instead of job openings where it softened back to pre-pandemic levels, hires have fallen even further and are now at levels commensurate with where we were in 2015, 10 years ago, instead of just prior to the pandemic. Now we can look at this and ask the question, what does this mean for the labor market? And there are a couple of different lenses to assess this question from. When we think about this difference of job openings staying more elevated than ultimate hires, one outlook could be that this is telling us that the labor market is actually still tight, on the tighter side. Because companies want to hire workers, job openings are elevated, but the talent is not necessarily available for them to go out and hire them, which is why it's lower. Conversely, we could look at this from the other side of the equation, and if any of you have either been in the labor market yourselves or know somebody who's been out looking for a job recently, it could be that maybe job openings are a little bit overstated. Maybe not all of these companies that are posting these job openings are as willing or readily available to hire as that indicator might think, and hires are really the more true measure of where labor demand has been, and we've seen that fall even further. So this is our first indicator that we're looking at to assess that last question, that philosophical question. On the one hand, this could tell us that the labor market is still strong. On the other hand, it could tell us that the labor market is weakening. So we're going to have to dive a little bit further. So we're going to pull up the other side of the equation now. We have hires and we have separations. Separations are the number of people that are leaving their job in any given month, both voluntarily through quits or retirements and involuntarily through layoffs and discharges. Now this here is a visual representation of what Donna mentioned earlier in State of the Line, the low hire, low fire environment. Because similarly to hires, separations are at 2015 levels, not 2019 levels. Now when we think about this, it has two implications that I want you to walk away with. One for the economy and one for workers' compensation. First, we're going to start with workers' compensation. When we think about this slowdown in turnover that we've experienced, fewer hires and fewer people separating from their jobs in any given month, this slowdown in turnover has significant implications when we think about short-tenured workers. Workers with less than 12 months on the job, and we know have a statistically higher likelihood to get into an accident. Now, let me put some numbers on this for you. If you look at the blue line back in 2022, at the peak of that great reshuffle period, the economy was hiring, on average, in any given month, about 6.5 million workers. Now, compare that to where we were for most of 2025, just above 5 million workers per month being hired in. Some rough back-of-the-envelope math tells us that that's 13 million fewer new hires for that year, a significant reduction in short-tenured workers over that time. Now later on this afternoon, Paul is going to go into the details of exactly what we're seeing in our data from this short-tenured worker cohort, but I wanted to point this out for you now ahead of time to wet your whistle a little bit for that excitement to come. Now for the economy though, we want to look at the difference between these two lines, the gap here which I've highlighted for you now. In blue, we have periods where hires exceed separations, more people being hired into a job in any given time than leaving, and that means on net employment is growing. Conversely, we have in the yellow times where separations are higher than hires and on net employment is shrinking. So let me zoom in on these lines for you to take a closer look. Now, typically, we see hires exceeding separations, the blue line above the yellow, through most of the last 2 decades. And during times of economic stress, during recessions, we see the reverse. We see separations exceed hires and we see net employment shrinking. But as we look over the course of this entire period, you'll notice in more recent times on the far right that we've seen some inconsistencies. We've had several months with hires exceeding separations and several months with the reverse happening. Now let's zoom in on that real quickly to see what's going on. This is net job growth on a monthly basis. And the trends here have been shifting pretty quickly. We go back to 2024, which we saw a significant slowdown in the pace of net employment growth from previous years, that great reshuffle time, averaging 122,000 jobs added per month. Now, just for a little bit of context for everyone, if we think of the 5 years prior to the pandemic, we averaged almost 190,000 jobs added per month for the entirety of that 5-year period. So a significant slowdown that we saw in 2024. Now compare that to 2025. Very different picture now. About 10,000 jobs on average added per month over the course of that year. Only 116,000 jobs added for the entirety of that year, compared to the 190,000 per month that we added for that 5 years prior to the pandemic. And you can see if you look even more closely that most of that strength was at the beginning of the year. In fact, after April, the economy added very little jobs for the remainder of that year. But we do have a little bit of good news. Does everybody like good news? A little bit of good news. At the beginning of 2026, things are starting to look a little bit better. We did have the large month of decline in February. There were a couple of things going on during that time period, some inclement weather, some very, very large strikes. But the average for the beginning of this year is starting to rise again, up towards 76,000. I do have to put a little bit of caution on that. We cannot get too excited just yet, because the economy, as it likes to do, throws curveballs at us quite often. Usually right before this presentation that I'm about to give, making my life a little bit more fun. But we have the new conflict going on in the Middle East. We have the significant rise in energy prices that we've seen. And so we have to watch the data over the next couple of months to see how sustainable this early trend in acceleration that we've been seeing is going to hold on through that time. So let's shift lenses here for a second and move away from the national, and let's look at it across states. Now you're seeing employment changes in 2025 across the entire landscape. And what you'll first probably notice about this chart is there's really not much color at all. And that's the story. Most states, similar to the rest of the country, added very little jobs over the course of that time period. A couple of exceptions you can see in orange: Nevada, Idaho, the Carolinas, and a couple of exceptions in the blue. We have Maryland, we have DC, Iowa, and Oregon. Now let me show this to you on the bars again to help really bring this into context. You can see on both sides of the chart, we had a small handful of states with above average growth in employment, and we had a small handful of states with below. Now DC and Maryland, I do want to remind everybody that we had the record-long government shutdown at the end of last year, and that significantly impacted those numbers for those states. But most states lying right in the middle, either side of zero, very little employment growth on net overall. Now let's switch lenses again now and look at it from an industry perspective instead. So from the end of 2024, here now we're looking at total non-farm employment in blue with that slight bit of growth that we've seen. And you can see here transportation and warehousing. This was the biggest loser of industry groups out there. The largest employment declines that we saw over this time period. We also saw employment declines in government jobs. We saw employment declines in office, in manufacturing, in total trade. That includes retail and wholesale as well. Now, it wasn't all a negative picture. We did see some employment growth in all others. This includes personal care services and education. And we saw employment growth in construction. And I want to pause here quickly because the trend in construction has been very interesting. Through most of 2025, you'll notice that construction was declining and was one of the more significant decliners. But starting at the very end of the year, we started to see construction turn around. And into 2026, we've seen a nice rebound, bringing construction up towards the top and back into growth. Now, this is an important consideration that we think about because we know how important construction is specifically for workers' compensation. And again, as we think about those new hires, those with less than 12 months tenure on the job, if we start to see this trend in construction continue, we'll have to keep an eye out for those short tenured workers in this industry. Now, we've also seen growth in leisure and hospitality services, and then finally, healthcare, which really just dominates the entire picture. This is an encapsulation of that one industry story that we talked about earlier. About 4% growth in healthcare compared to small percentages in everything else. Healthcare offsetting all of the declines as well. Over 100% of all jobs that we added in 2025 were in healthcare and social assistance. Now, a quick summary of what we just talked about from the demand side of the equation. Demand has softened, but we don't yet know whether that softening has been because of weakening in the labor market or if something else is going on. So let's now look at the other side of the equation, and let's look at supply. So here we have the labor force participation rate for all workers 16 plus. Now, not to give away a spoiler of later this afternoon, Patrick's going to talk to you in depth about population demographics, but with the constrained population growth that we have, labor force participation becomes a much more important metric to watch for the growth of the labor force overall. What you can see here is a largely declining trend coming out of the great financial crisis in 2008 and 2009. We saw it dip during the COVID pandemic, recover some, and then for the last couple of years has been continuing to decline again. This actually tells us nothing about the labor market. In fact, this is mostly just an aging population story. Remember, this is all 16 plus workers. If we narrow this down to prime age workers, those 25 to 54, you can see a very different trend now. Instead of a long-term decline in participation, you can see the participation accelerated prior to the pandemic, came down during, then recovered quickly after, and continued to rise. In fact, prime age labor force participation is actually near its all-time high. There's not much more that we should expect to be getting as far as participation for those in their prime ages of work. And it's really coming from younger workers and older workers where we've seen the participation rate slowing down. Now, Patrick's going to tell you a lot more about that later on, but let's flip back now to what this means again for employment growth overall. So heading back to the chart that I showed you before, but now I've put a new line on here. This is an idea from economists called break-even employment. Essentially, how many jobs does the economy need to add in any given month in order to keep the unemployment rate from going up? And estimates from the Federal Reserve Bank of Dallas show that, as you can see, break-even employment gains right now are estimated to be right around zero. I'm going to leave that to sink in for a second. The economy does not need to add any jobs to keep the unemployment rate from going up. Does that concept strike anybody as odd? Again, you're going to hear more about the population side of things later on, but that's really the key driver there. Now, this concept, again, is just a concept, but let's take a look at the data and see what it's showing us. When we look at the unemployment rate over the last couple of years, you'll see that we've had very little change. Since about mid-2024, the unemployment rate has been relatively steady between 4 and 4.5%, flat in the most recent month, the day that we got on Friday, and not much change overall for this time period. It actually lends quite a bit of credibility to that idea of break-even employment being as low as it is overall. Now, the unemployment rate is another indicator that we want to look at to assess that question. Is the labor market strong or is the labor market weak? And if we look at just this short view here, you can see that the unemployment rate has trended up over the last couple of years from a low of 3.4% back in 2023, now to the 4 to 4.5% range that we're in right now. But if we zoom out and look historically, it's a very different picture. Where we are right now at 4 to 4.5% is still historically low and would tell us that we are still in a tight labor market environment rather than one that is loosening up. In fact, if you look at the time period from the early 1970s all the way through the late 90s, we went almost 30 years in the economy without experiencing an unemployment rate as low as what we have today. So even though we have seen the unemployment rate come up a little bit, historically still low and still leaning towards the tighter side for the labor market. Now let's bring both sides of the equation back together. Let's bring labor supply and labor demand together. We have labor supply as measured by the number of unemployed workers. We have labor demand as measured by job openings. Using these two figures specifically because this is a metric that's often cited in the media and by the Federal Reserve, the number of job openings per unemployed worker. Essentially, if we took all of the workers looking for jobs and put them in a job, how many job openings would be left, or would we have a deficit of unemployed workers that would not be able to be put into jobs? Now, a couple of things to point out here. First, on the right-hand side, as we look at the time period from about 2015 through today, aside from a couple of months during the pandemic, we've largely been operating in a time period of relative balance or a tighter labor market, where the number of job openings is exceeding the number of unemployed workers. Said a different way, if anybody who wanted a job got one, we would have more jobs available than people to fill them. Now, just recently, this relationship has flipped some, so now we have just slightly more unemployed workers than job openings, but still largely a balanced labor market overall. Contrast this with the far left-hand side of the page now. Coming out of both the dot-com bubble as well as the great financial crisis recessions, significantly loose labor markets where at some points we had upwards of 2 to 3 times more unemployed workers than job openings available for those workers to move into. So as we think about the encapsulation of this story, even though labor demand has come down, labor supply has also come down at the same time, leaving us roughly in balance for the labor market, and why we've seen very little movement in the unemployment rate, despite not adding very many jobs overall in the economy. Now, there's one other indicator that this has meaningful implications for, and it's also the most important indicator that we talked about at the very beginning for workers' compensation, and that's wages. Why this all matters, bringing it together. With the labor market still roughly in balance, maybe leaning a little bit towards the tighter side, the trend in wage growth has been sustained over the last couple of years. You can see average weekly earnings, a measure of wage growth that we use, over the last 3 or 4 years has been relatively consistent in the 3.5% to 4% per year growth range, versus where we were prior to the pandemic, down in the 2.5% to 3% range instead. Now, if we break up average weekly earnings into its core components, we can see a little bit more of what's going on in that story. First, on the left-hand side in the blue, we have average hourly earnings. This is the hourly wage rate that employees are being paid. And this has been the primary driver of elevated wage growth, that hourly wage rate being paid out, still growing near 4% compared to down in the 2 to 3% area prior to the pandemic. But on the right-hand side is the other part, which is average hours worked per week. And this one is not just important for wages, but we want to think about this for workers' compensation as well. Now, the trend here was an increase during that great reshuffle period outside of the pandemic and then a softening back down. But similar to job openings, what we've seen is the average work week has softened more than where we were prior to the pandemic. Now, there's 2 key implications to this one as well. The first, for workers' compensation, this can be a measure of fatigue for workers overall. If each of your existing workers is working more hours, potentially more overtime, that can be more chances for fatigue, more chances for silly injuries to occur, more stress. All of these things can have impacts on frequency for some industries more than others. The other that I want to point out is where we are relative to the pandemic, and this is important for the economy. 34.5 hours prior to the pandemic, 34.25 hours on average now. Now, you might be thinking, Stephen, why are you making such a big deal about 15 minutes per week? Well, let me tell you, 15 minutes per week at 50 weeks worked per year on average, at $38 per hour, the average hourly wage for all workers across all industries, times 160 million workers is $80 billion of wages that are no longer being paid out because of that reduction in hours worked. Significant implications when we think about the purchasing power of consumers for the economy and also for the payroll story for workers' compensation. Now, I want to stay on wages for a moment because they are so important, and I want to flip to a different indicator now. So instead of looking at average weekly earnings, we're going to look at the Atlanta Fed Wage Tracker. Now, this follows an individual worker through time and allows us to control for the effects of industry mix, tenure changes, and other things like this that get included in the averages of the other metrics. Now, here you can see a similar trend. Not much interesting going on in this metric versus the other. Wage growth around 4%, a little bit above where we were pre-pandemic. But the reason that I bring up this indicator is because we can cut this several different ways that add some layers to the story. So the first way that I want to look at it is salaried workers versus hourly workers. Salaried workers in blue, hourly workers in yellow on this chart. And a couple of things to notice. Prior to the pandemic, we had a consistent trend where wage increases for salaried workers would exceed those of hourly workers by about 0.5%. Very interestingly, after the pandemic, this relationship flipped. And as wages for both cohorts started to increase, hourly workers were seeing larger increases. That yellow line moved above the blue line. And now in the last couple of years, it looks like the relationship has righted itself. We've seen both metrics come down, and the gap between them has been restored largely to where it was prior to the pandemic. But if we compare both of these lines back to where they were, each remains elevated over the pre-pandemic trend. So it is both hourly workers and salaried workers that are contributing to this higher wage trend that we've experienced. Now, there's one other way that I want to cut this for you that I think is one of the more interesting things to look at here, and that is by those that switched jobs and those that stayed in their job. Job switchers in blue, as you notice on the left-hand side, consistently saw higher wage gains than those who stayed in their job up until last year. And then something interesting happened. wage increases for both of these cohorts were the same. Now we think about this low hire, low fire environment, this low turnover environment that we've been in, very few people leaving their jobs. And this metric tells us that nobody really had any incentive to leave their job. If you weren't going to get any more of a wage increase by switching versus staying in your job, would you switch? Maybe some of you still would, but I think most of us might stick around. And now that helps to explain as we think about what's been going on with this wage trend overall. Because when we look at both of these lines compared to where they were in the prior period, wage increases for job switchers, the blue, is roughly back to where it was prior to the pandemic. But wage increases for job stayers in the yellow is still about 1% elevated over where it was in the past. And this tells me that employers are still paying up to keep their existing workers. They do not want to lose their existing work staff, and they are still competitively increasing wages for those workers in order to keep them around. Another indicator that tells me the labor market is a little bit more on the tighter side than weakening. So this is just a few indicators of the labor market. Again, like I said, I could go on for another 35 minutes about just the labor market, but I'll spare you that. Find me later if you have more questions. Let's come back to where we started. Let's bring this whole picture together. So looking again now at the employment, wage, and payroll story for 2024 and 2025, again, wages being the main shining star here, and from what we looked at, it looks like this wage trend might be able to continue, might persist into the future. And if we roll the data forward into 2026, looking at the first 4 months of this year, annualized for the full year, what you'll see is exactly that. Employment growth a little bit better than 2025, not by much. Wage growth about the same, and payroll growth about the same. But there's also a couple of things that I want you to notice that we've seen through the first 4 months of this year as well. Particularly in employment, even though the overall growth rate just went up from 0.5 to 0.8, I want you to notice across industries that now in early 2026, 7 of these 8 industry groups are now positive for employment growth. Contrast that with last year, where it was only 3 that were positive. So we've started to see employment gains broadening out, more breadth of employment gains early in the year. Again, I do want to caution, we still have a lot of year to come in front of us, but again, another encouraging sign as we think about where the labor market might be heading. Wage growth, again, largely still strong across the board, and payroll growth as well. So let's sum up the labor market section. Let's sum up employment here. Labor market remains largely in balance and is helping to support both wage growth and payroll and premium for workers' compensation. Reduced turnover trends can have implications for frequency, which you're going to hear a little bit more later on this afternoon. And we have some early signs of strengthening in 2026. If those trends continue through the rest of the year, the labor market is shaping up to be in a better spot in 26 than what we saw in 25. So now let's head back. And again, before we're going to get into growth, there's one more area that we need to look at for the context for the outlook for 2026, and we're going to head to inflation. And I'm going to break my promise to you again because I have another question. Why is everything still so expensive? Does anybody know? We'll get into that. What's the latest on tariffs? I mentioned that there were developments that happened in the economy just last week. The tariff story is apparently never ending. We have a new development that I'll talk to you about when we get into that. And then lastly, and this is where I'm going to need some audience participation, are we heading for a repeat of the 1970s? Who thinks we're going back to the 70s and not just for disco later tonight? Who thinks we're not going back there? Everything's fine. Who's tired of raising their hands? Well, I don't know about you, but I'm feeling 22 more than the 70s. But we'll get into that. I have to start this section, though, by talking about a word that has started to be thrown around in the media again recently, and that is stagflation. Who's heard stagflation in the last couple of months? Almost everybody. Thank you for raising your hands. I appreciate that. Now, stagflation is important because in economics, this is a very, very specific term that refers to a very specific situation. And a lot of times when it gets thrown around in the media, it's not necessarily referencing what it actually is. So stagflation is specifically when inflation and unemployment are rising at the same time. And that is very important because when you think about the Fed and their response to both sides of their dual mandate, If both inflation and unemployment are rising at the same time, policymakers cannot address one side of their mandate without harming the other. That's what makes stagflation so dangerous overall. That's what we experienced back in the 70s. Now, stagflation typically occurs when you have a supply shock to a natural resource. And what did we just experience? A supply shock to a natural resource. We have an oil shock that just occurred over the last couple of months. Now, oil shocks are not uncommon. I have the history here for you going back to the early 70s. We don't really need to go back much further than this because prior to 1970, oil prices were largely fixed. It was not an exchange-traded commodity. But then things started to change in the 70s, and over this time period, we've experienced 8 oil shocks that I want to highlight for you here in yellow. Now, a couple of things to notice when you look at these different oil shocks. Looking back at the first 5 prior to 2009, you'll notice that each of these oil shocks was either coincident with or just before a recession, as indicated by the gray bars. Then something changed. In 2011, and then again in 2022, and now in 2026, we've seen 3 oil shocks that were not coincident with or just before a recession. 2011 is a little bit hazy because, as you may remember back at that time, there was fears that we were going to go into the double dip recession coming out of the great financial crisis. Europe and other countries did experience it. We somehow escaped as they revised away a lot of weakness in the data. But the 2 most recent oil shocks specifically not coinciding with economic weakness. Now we want to look at 4 of these oil shocks specifically for today, as we're going to get to that question that I asked at the end. So I'm highlighting for you 1973-74, 1979, and then the 2 most recent, 2022 and 2026. And before we get to comparing these individually, there's one more thing that I want to point out. As you look back to the 70s, notice that this was a compounding shock that we experienced. Prices rose in 73-74, continued to rise through the decade, and then we experienced the final shock at the end of the decade. Very different in contrast to what we experienced most recently, where we saw the shock in 2022 when Russia invaded Ukraine. Prices then came back down even lower than where they were prior to that shock, and now we have a new shock again, bringing prices very coincidentally back to about the same level. The peak in 2022 is $115 a barrel. The peak just a couple of weeks ago was also $115 a barrel. But let's look at these individually now on an indexed basis so that we can compare them more closely, because on the last chart, the 1970s looked relatively small, didn't they? So here we have just that first shock, and oil prices went from just below $4 a barrel to nearly $10 a barrel over the course of this time, almost a 200% increase in the price of a barrel of oil. Now, how many of you out there remember the odd-even rule? Couple of hands going up. That's okay. You don't need to out yourselves if you were around and driving back then. During this period, this was such a shock, and there was such a worry about running out of gasoline that the odd-even rule was put in place. If the last digit of your license plate was an odd digit, you could go to the gas station to fill up on odd days. If the last digit was even, you could go fill up on even days. Even with this rule, we experienced lines down the street, and there were significant shortages of gasoline. Then we have the next shock, very similar in size, but over a much longer period of time in 1979-1980. And the combination of these 2 shocks brought oil prices from just above $3 at the beginning of the decade to near $40 by the end of the decade, an almost 1,000% increase over that 10-year period. Now, if we compare to today, first let's look at 21 and 22, a very different story. Prices went up just shy of 100%, came down a little bit more, back up, and then ultimately when the shock subsided, we saw prices go from that peak of 115 back down into the 50s and 60s within a couple of years. Putting up the most recent shock, again, a similar story, around 100% increase from the low 50s up above 100. And as of just about an hour ago, we were at 101.50 on a barrel of oil. So a little bit off of the peak, but still very elevated. So this shock is not over yet. Now, when we think about the impact of an oil shock, it comes to the question of inflation. And what is that oil shock going to mean for the economy overall? So if anybody followed the inflation report this morning, and I'll apologize to you that I don't have the most recent data point on here from 8:30 this morning, But we saw inflation increase from the 3.3 that you see on the far side of this chart up to 3.8%, so another half-point increase. And we're now heading back towards what might look like 2022 all over again. But when we dig into the details, things look a little bit different. So maybe my Taylor Swift reference was a little bit wrong for those of you that even understood that reference to begin with. When we compare what's going on to today to 2022, some very key differences that we need to look at. First, starting back in 2021 and 2022, when inflation started to increase, you'll notice that we have here energy, food, and then all items excluding food and energy, what we call core inflation. We did see the dark orange bars increasing in size, the contribution from energy increasing back then, very similarly to what we see today. However, look at the light blue now, also increasing significantly during that time. Do any of you have friends in personal lines, or maybe yourself have worked in personal lines before? You'll remember that this was the time period when new and used car prices started increasing rapidly, when building materials started increasing rapidly, when we saw other areas of inflation because of the pandemic, because of supply chains, because of shortages, also increasing along with energy. Today, we largely do not have this phenomenon going on. So while we do need to be very mindful of energy prices because they can impact the prices of other goods and services, very distinct differences from some of the pandemic impacts that we saw back in 2022. Now, with that being said, how many of you have paid a fuel surcharge recently on a good or service? I know I have personally. We just got our mulch delivered to do the garden and paid an 18% fuel charge on the delivery of the mulch. This is how higher energy prices can feed into the prices of other goods and services. Transportation costs, production costs, all reliant on energy, we can start to see it flow in. So far we haven't, largely, but we'll need to keep an eye out for that as we go on for the next couple of months. Now let's dive into some of the details of core and see what's going on there, because this is where the tariff impacts come through. Now, I've broken down core into goods and services for you because tariffs largely impacting the goods side, and I've highlighted that light blue box for you down there at the bottom. That is your tariff impact. Kind of small, right? Not really a big deal. Well, it's a little bit more than that, and we think about the trend just prior to that, core goods prices were decreasing anywhere from about 1/4 to 1/3% over the time period. Now switching to 1/4 to 1/3% increase. So about 0.5% higher inflation from tariffs than if they were not have to gone on. Now, tariffs are very interesting because they continue to evolve. I'm sure everybody has heard that the Supreme Court ruled that the tariffs under the IEEPA were illegal and that refunds would be paid back to businesses that paid illegal tariffs under that ruling. Well, just last week, a 3-judge panel at the International Court of Trade ruled that the replacement tariffs, a 10% tariff across the board on all imports under Section 122 of the Trade Act, were also illegal. Now, that does not mean that tariffs are going to go away, and I'll caution again, tariffs are a key cornerstone of this administration's trade policy. They're just going to be pursued under other metrics that take a little bit longer to be implemented. So I would not expect this contribution from core inflation to be disappearing at any time. But largely tariffs have been offset by the dark blue here, which is core services. And the largest portion of core services is housing. We've seen a slowdown in the increase in house prices, the pace of increase in house prices, and that has largely offset what we've seen from tariffs. This is the #1 reason why the tariff impact has not been as meaningful in the aggregate as some might have expected after the announcements came through. Now, the last thing I want to do is pull the full picture back together, because we think about where inflation is going forward. We have that 1 month of the dark orange bar growing. With the most recent print that we got this morning, that has continued to grow with that 3.8% inflation print from this morning. So we're going to have to continue to watch, one, how long we see elevated energy prices and how much energy prices permeate into the price of other goods and services. Now, there's one last thing here before we move on, and that's the area of inflation that I didn't talk about, and that's medical inflation. Medical inflation is in the dark blue segment here, and as Donna mentioned this morning, medical prices have been relatively consistent in the rate of change over the last couple of years. Not much worth really diving into the details beyond what she shared. But I do want to point out, as we think about one other thing that she mentioned, states that have fee schedules that are indexed to overall economic inflation may see higher price changes because of these higher energy prices than states that are tied to Medicare. So something that we're going to have to watch out for as well in comp. Now, inflation is important for the economy as we bring this back to prices. And prices really mean affordability. So affordability has been a key issue in the media and is likely to remain a key issue as we go forward. And here is where I'll once again remind everybody that inflation is the rate of change of prices, and prices themselves continue to go up. As inflation came down, that just means things got more expensive more slowly. And now that inflation is accelerating again, it means that things are getting more expensive more quickly. Prices now, as of this morning, about 30% higher broadly across all goods and services compared to 2019. But the important factor is not just what the rate of inflation is, it's inflation relative to wages. So let's bring the average weekly earnings back up and now compare that to inflation. The gap between here again is the most important thing to look at. Areas shaded in green are what we call real wage increase periods. Purchasing power for consumers is going up because the average increase in their wages is higher than that of the average increase in prices. Absent a small period in 2022 when inflation peaked at 9%, we've largely been living in a positive real wage environment. Now, as of this morning's print again, this has now flipped negative. We are back in the blue, minus 0.2% year over year change in real wages. So again, the question is one, how high does inflation go above wages? And how long does inflation persist above wages are going to be the key questions for the strength of the consumer and for the economy overall. So let's wrap up what we talked about here now in inflation. Tariff impacts to inflation so far have been minimal overall, and that story is likely not to go away anytime soon. The oil shocks of today have been relatively minor compared to history. Doesn't feel minor when you go to the pump, but relative to what we experienced in the past is likely to keep us from entering a stagflationary period again. And lastly, accelerating inflation once again renews concerns of affordability, with real wages being the key. So now that we have these two segments as backdrop, what's been going on in the the labor market and what's been going on in inflation, let's get to growth and let's get to the outlook for the economy overall. Now, if I told you that the economy added no jobs, inflation was persistently above target, consumer confidence was at all-time lows, and gas prices were now back over $4 a gallon on average, how would you guess the economy is doing? Did I make it too obvious, too on the nose? Actually, the economy held up relatively well in 2025, growth of 2%. But the most important question, 2026, what is on the horizon given this backdrop? So let's get into the growth of 2025 before we get into the outlook just briefly. And what I want to talk about here first is fundamentally there are two ways that you grow your economy in simple terms. Number one, you can add more workers. More workers can produce more goods and services. And number two, and this is the more difficult way, is you can have your existing workers make more. Productivity could increase. So even though we didn't add any workers on net for 2025, we still saw a growth of around 2% in the economy because of the latter half, because of productivity increases. And so that was the interesting story and takeaway. Now, the details of 2025 are a little bit interesting as well. First, we saw wild swings at the beginning of the year here with net exports in Q1 and Q2, offsetting with investment in Q1 and Q2, and then we had the government shutdown in Q4 in the white. Now, you might be thinking, looking at that orange bar in Q1 and Q2, oh, investment, that's companies building equipment and buildings, maybe data centers, but actually, no, it's really just inventories. And that's a little bit of a calculation quirk for the economy. We brought in all of these imported goods. We did not sell them, so we put them in inventories. And then in the second quarter, instead of bringing in new imports, we just pulled those goods out of inventories and sold them back. But I want you to focus on the full year number on the right-hand side. Despite all of these major fluctuations throughout the year, you'll notice that the contribution to the full year from inventories and net exports is largely zero. And that's actually traditionally how things work in the economy. We see short-run fluctuations in these metrics, but largely they balance out over time because, again, they're a little bit of an accounting quirk. One is just a geographic distribution of where growth is coming from. Was it local or was it abroad? And the other is a timing distribution. Did you purchase it this quarter or did you purchase it next quarter? And largely they balance out. But what's the most important thing to look at is the blue bar, and that is personal consumption expenditure. That is each of you in this room going out in your everyday lives purchasing goods and services. It's about 70% of the economy. It is the backbone of growth. Where the consumer goes, the economy ultimately goes as well. The trend in the consumer held up well during 2025. There are some headwinds for 2026, but the consumer has remained resilient partly because of the wage trend that we've seen, and partly because even though consumers have been complaining a lot about how the economy's been going, consumer confidence, they've largely still been going about their daily lives without much change. So let's shift now from the growth picture overall and let's look at it by state. And here you can see very consistently across states growth. Most states here in orange, we have a couple of exceptions. The biggest one that you can't really see up there is DC, the only state that had a material decline. So let me change the picture a little bit and let's look at growth relative to the overall country instead. The overall country grew at 2%, so now you have shaded states in orange that grew more than 2%, shaded states in blue that grew slower than 2%. And the key takeaway here is there really is no geographic distribution. When we think about the contributors to growth, it is widespread across the country, several states growing higher, most states growing at or below. Let's take a look at on the bars again here to help you visualize it. Now, is anybody in the room from the Northeast? Raise of hands. Relatively good Northeast representation. Myself, I'm from Connecticut as well. Would you be surprised to see Massachusetts, New York, and Connecticut as 3 of the top 5 growing states? I was quite surprised as well, and I think most of us would be. But there are other states that I want to highlight in that top, 18 states that grew above the rest of the country, 5 in particular, and those are California, Texas, Florida, New York, and Illinois. The 5 largest economies in the country all grew more than the country did overall. So when we switch to a contribution lens, you can see how the large states dominated the picture overall for the country. And most notably, you can see California. If the United States were to break up into individual states, California would be the 3rd largest economy in the world, just behind China and Germany. Recently, California surpassed Japan to become that 4th largest. Texas would be 8th, and New York would be just outside of the top 10. So a very large contribution from those states. So let's take the past now and let's look forward. What does this mean for the outlook in 2026? And we're going to start here with predictions from economists. So quick poll of the room. Who thinks economists are more optimistic about 2026 than they are about 2025? No one. Okay, we got a couple hands. Excellent. Who thinks economists are more pessimistic about 2026? Economics is called the dismal science for a reason, right? Who thinks it's about the same? Those of you that waited to raise your hand, you're right. The median forecast from economists for 2026 is largely unchanged from 2025, just above 2% growth. But there is one more important thing that I want to point out here, and that is the skew. Typically, the skew is downward. Again, most economists are dismal, and some are predicting recessions. But here we have a relatively balanced skew, an equal number of upside versus downside. And I think that's interesting. We'll have to see how that ultimately plays out. Now, there are a couple of risks that we need to keep in mind when we think about for the rest of this year. So on the upside, we have productivity. Productivity was the key behind 2025, and that story is not going anywhere. We have early signs of a labor market rebound, and that could take some of the pressure off of productivity or combine with productivity to lead to even higher growth. And then lastly, we have the combination of tax and tariff refunds. Individual tax refunds for households this year were on average larger than last year, thanks to the One Big Beautiful Bill Act, and $160 billion of tariff refunds going back to companies represents one of the largest corporate stimuluses we've seen in recent times. Now, we do have to be cognizant on the downside. Economic uncertainty is still around and is now increased again with the conflict in the Middle East. We have stagflation, while not our base case. We do need to keep an eye out for that. And then any unforeseen shock. Typically, what causes recessions is the unknown, so we always have to be on the lookout for what we don't know and we can't see, right? So let's wrap up this last section. Economic resilience has been a recurring trend and is likely to continue into 2026. We have accelerating inflation that is a risk for consumers, but largely consumers have been resistant to it so far. And productivity has been a key driver of growth and is likely to continue into 2026, ultimately leading us to a relatively stable outlook for the economy. Now let's head into our last section, into the future. And the future of work is really what we're looking at here. And so before we get into this segment, there's only one question that I have to ask everyone in the audience. Are the machines coming for your job? Raise your hand if you think the machines are coming for your job. Raise your hand if you think the machines are coming for your next door neighbor's job. All right, so before we can assess the future, as economists typically do, we're going to look to the past. And we're going to start with a brief history of the machines taking your job. And our story today starts in 1850. In 1850 through the early 1900s, we had inventions such as the steam engine. We had the printing press permeating across the economy. We had automated looms changing the face of the textile industries. And what did these inventions cause? They caused very upset people. The steam engine coming through to terrorize your neighborhood, defend your kids, workers going on strike because the sewing machines are taking away their jobs, and the Luddite Revolution, where workers actually destroyed the machines that they believed were the enemies. Now, if you had to guess, what do you think happened to employment over this time? That's right. Employment increased from 4 million at the beginning of this time period to near 16 million by the end. But more important than the number of workers that we had is what were those workers doing? Let's take a look at the share of jobs across some industry groups. And one thing key to notice here is that there was change, there was disruption in the labor force over this time. We saw a significant reduction in the amount of workers in agriculture, from 60% of the economy in 1850 down to about 40% of the economy by the turn of the century. And what that led to was growth in trade, growth in manufacturing, growth in transportation, and mostly at the bottom, growth in what we call relational services, people-to-people services. These are things like education and healthcare, professional services, personal services, leisure and hospitality, accommodation, arts, entertainment, etc. Now let's roll the calendar forward. Let's look at the next 50 years, 1900 and 1950. Now we have the automobile that has come around. Very famously, Henry Ford quoted, "If I asked my customers what they wanted, they would have told me a faster horse," not the automobile. We have the assembly line and the moving assembly line that were coming in to disrupt manufacturing. And what can you guess happened at this time in the media? Of course, more panic. Unemployment blamed on the new machines, unemployment's effects on the literary arts, the march of the machines and the idle hands that it's going to make. And I'm sure you can guess again what happened to employment over this time period. Well, it grew significantly, from about 16 million at the turn of the century to near 50 million by the 1950s. But again, importantly, let's take a look at what people were doing, because this is where we again see the shift. When we roll time forward, you can see more disruption in agriculture and mining. Now, 45% lower share than where we were back in the 1850s. And where were those workers distributed? Into trade, into manufacturing. Manufacturing seeing significant growth over this time. Some government, remember this was the New Deal coming out of the First World War and the Second World War, and then again in relational services. So let's roll time forward one more time. 1950 to 2000. Now we have computer processors that start to come about in the early 70s. Then personal computing and the internet coming into play at the end of the century. And again, without burying the lead here, I'm sure you know exactly what I'm going to show you. More fear, more panic, more media upset with automation destroying jobs. Chips coming in to take everything. The end of work as we know it. Intentionally flippant. So what did we see with employment over this time period? I'm sure you can all probably guess again. In fact, this was the most significant 50 years of employment growth that we've experienced in our country. You can see the exponential increase that we had during this time. Technology enabling more workers. Let's look again at the share. What were people doing? Because we have another disruption that came about during this time that's important to focus on. When we roll time forward again here, you can see we've almost eliminated the entire share of workers in agriculture. From 60% of people being directly involved in producing the food that they consume in 1850 to now less than 3% during this time. More growth in trade, and now I want to point out manufacturing. Manufacturing gave it back. Peaking in the 70s as a share of work, manufacturing then started to decline again because automation started to move more fervently in that sector. Work instead started to grow in places like telecommunications, government, financial services, that's us all here in the room, and then lastly in relational services again, the most significant growth during this time period in those people-to-people services. So let's round things out. Let's fast forward to today. Now we have again, the internet is ubiquitous. Personal computing is everywhere. It is in the home, it is in the workplace. We have cell phones, and then we have the smartphone now in just about everybody's pocket. We are all connected at all times, 24/7. And a familiar story, the media, maybe it's their problem. Maybe it's just the media, you know? They're too pessimistic. Technology is going to take away jobs. AI is costing workers. We need to give people money because they're not going to work anymore. More fear from the media overall. Now, I've already given it away, so this last segment, again, we did see employment continue to grow during this time, but let's shift again to look at the most important change, which is what workers were doing over this time. So culminating for the full 175 years that we're showing you, significant reduction in agriculture, increase in trade, small decline in manufacturing, increases in government and financial services, and a significant increase in relational services, people-to-people services. So I want to round out this last section now that we've looked to the past and think about the future for a moment. And I'm going to just start this segment with, I am not an expert on AI. I am not an expert on robotics. But I am an economist, and I do follow a number of other economists that are much closer to this stuff than I am. And what I can tell you today is that the views from economists are largely split right now on this question. There is a camp of economists that believe that the technological change that we're experiencing right now is so quick that the labor market is not going to be able to adapt quick enough, and that we could see some significant disruption in jobs while the labor market catches back up. Reskilling of workers, changing in the types of work, and we may see some disruption during that time. Now, on the opposite side of the spectrum, there are a number of economists that believe we are actually on the frontier of a new boom in labor, similar to what we experienced in the 1950s to 2000 period. Now, that might strike you as thinking a little bit odd, given some of the stuff you've heard today and what you're going to hear about in a little bit after this, but there's an idea in economics called Jevons paradox. And this idea came about actually in the very first time period I talked to you about, the late 1800s. The idea here was that when the steam engine came about and started to permeate across the economy, it was so efficient in what it did that the amount of coal that we were using was going to be significantly reduced. However, after the steam engine made its way into every facet of manufacturing and other areas of the economy, what actually happened was the amount of coal we used increased with it. Because it made such bounds in productivity, because it made its way into so many areas, it unlocked more use cases than it did from the reduction. Some very prominent economists today have likened AI similar to coal in this case. If the productivity gains that we do see from AI are of some of the things that have been promised out there, it may lead to even more labor being employed to unlock those productivity gains, to increase growth in the economy and incomes in the economy exponentially. Something to think about. Now, I want to think about again, as we talked about, the types of work that people are doing. Because if there's any one thing that I can tell you with certainty, maybe certainty is a strong word, any one thing that I can tell you with confidence, it is that there will be some jobs today that are not going to exist in the future. And that has happened throughout history. Think of switchboard operators, think of elevator attendants, think of buggy whips. Very common examples in economics of jobs that existed in the past and are no longer with us today. And there are probably going to be some in the future as well. Data entry is a field that's already starting to disappear, and technology probably going to continue. But there are new jobs that are going to be created on top of that. If I go back in my life 20 or 30 years and think of my younger self, what did I want to be when I grew up? Most of the kids my age would say, I want to be an athlete, a baseball player, or an actor. What happens when you ask kids nowadays this question? What do they tell you? They want to be a YouTuber, right? If I looked at my younger self and I said, you can make silly videos of yourself and post them on this thing called the internet for everybody around the world to watch, and you could get paid millions of dollars to do that, I would have thought future me was insane. But we've seen growth in areas like streaming, influencers, changing the way people are interacting with people in the economy. Again, it's these relational services that we're seeing continue to grow. So the last thing that I want to leave you with here as we think about what the impacts could be to the future of work, the relational sectors are where we likely see the most growth going forward. When we think about how jobs are going to be changing over this time period, I'll leave you with a bit of sage advice that I'll give to anybody that asks. If you have any young kids and you want to steer them into the direction of a job that could be safe in the future, have them become an electrician, because data centers need a lot of power. Or have them become an HVAC technician, because both people and data centers need to be cooled, especially when it's 96 degrees out like it is today in Florida. Let's wrap up everything here. Technological change has been consistent for the last 200 years in the economy and is not something that is ever going to go away. The labor market continues to deal with changes. Sometimes changes can be fast and lead to disruptions. Sometimes the labor market can evolve around them. Some jobs are going to cease to exist while new ones will be created. And lastly, the relational sectors, people-to-people services, likely to account for the largest share going forward. So this has been a slightly over an hour view of the state of the economy. We had so much content this year to give you that we weren't able to touch on all areas. So please, I do encourage you to find me at the Meet the Experts booth during the next break. Find me later this afternoon. I welcome your questions, I welcome your feedback, and I look forward to engaging with you. Thank you all.